thanks for everyone to attend the live version of today's broadcast. Um, when I saw the proposed the suggestion of the subject for today, I thought that's ideal. That's probably the one of the key questions a lot of investors have at this point in time, and I can only imagine that many of today's viewers have some mixed feelings when it comes to the share market over the past 2 years or so, because as we will see in today's presentation, a lot is going to happen over the next 2 years. And as we've all, I'm sure haven't forgotten yet, a lot has happened over the past 2 years. And one is very much strongly correlated with the other one. So let's get started, shall we? I'm gonna now share my screen, which would make it easier for everyone to see what exactly I'm talking about. And this is the title of today's session. It's about investing for income, investing in dividends, investing in the share market with exactly that purpose. And before we continue, I'll have to make this point, of course, is that I'm willing to share all my own research, my knowledge, my insights, and all of that. And but everything I say, show, and predict, and forecast, and describe today cannot and should not be considered financial advice for obvious reasons. I have no idea who you are and what you want to achieve in life and in the share market. But having said so, I think the topic of investing for income is very prominent in today's market, just as it has been over the past decade or so. But before we move to the events that have preceded 2021, and before we move to the final details of investing for income, I would like to share two narratives with you that I believe should equally become part of your knowledge and of your insights of investing, because I truly believe that while most people make a difference between investing for return and investing for income, I truly believe that to paraphrase Warren Buffett and Charlie Munger here, that both are joined by the hip, and there's actually not much of a difference between the two. One of the narratives I want to share with you here is a story I wrote a little bit less than a decade ago. So I thought it was quite apt to point it out here, for the simple reason that, of course, that the value of this narrative remains as active today and as valid today as it was 10 years ago. And after 2010, I made a proposition to investors, and I said, let's assume for the time being that we have this magic power. We can go back into the past with the knowledge and the money we have today. And at the time, I chose January 2003. The reason is, in that time, we were just coming out of a new bear market. I'm going to take a sip here now because my voice is going. Excuse for that. So at the time, we were coming out of a bear market, and we were obviously preparing for a commodity super cycle to come. So that's the knowledge we have. And since we're going back in time, we have a choice. We have to put all our money in one stock, and we have a choice out of two. One is at the time, not so well known, smaller retail, a little bit upmarket, called David Jones. It was okay. People knew about it. And the other one was a very well-known miner, one of the champions of the commodities sector, Rio Tinto. And of course, if you have that proposition, then most investors would think like, well, there is no choice. With the knowledge we have, of course, you would choose Rio Tinto. And at face value, you've actually done very well. The share market over that period, because there is, of course, after the first phase of the commodity super cycle, we also get a very big bear market. So the average return over that period is about 8% in the share market. That is combined, including the dividend payouts. And as you can see on this little overview, that Rio Tinto beats that hands over fist. I mean, the return out of dividends was 32% of that period, and the return out of share price appreciation a little bit over 150% of that period. So at the end of the day, you make 185%, you've done well. Now, the disappointment comes then that you've actually left a lot of money on the table. Because if you had put all your money in the little David Jones at the time, you would have done more than double better. And that is what a lot of people always fall off their chairs because I can't believe it. But that's why I, at the time, and as I do here, I simply put out the data so you can check it yourself. But long story short, the total return you would have had from David Jones, the total return you would have had from Rio Tinto is almost matched by the total dividend payout of David Jones over that period. In other words, the bigger return out of the share price appreciation, which is more than 300%, is what you get extra on top. And that, I think, is one of the narratives you should always keep in mind when you invest in the share market. It's not what you think it is, it's what you actually find out what it is. And just continuing on this way, I have another narrative for you, which might be equally surprising and nevertheless very important and valid. It is that luckily all the price charts of Google Finance these days go back to the late 1990s, and that is when Telstra listed on the stock exchange. So I've taken here CSL and Telstra, and the irony here is that nobody would think in terms of I'm going to buy CSL for the dividends, but everyone would think I'm going to buy Telstra for the dividends. And I'm pretty certain that many of you would have held Telstra, if maybe still holding Telstra, for particular that reason in the past and maybe in the present. Now, the irony here is that if you had bought CSL shares at the time of the Telstra listing in the late 1990s, then over that period until now, or even 5 years ago, you would have received more dividends from CSL than you would have from Telstra. Now, that is a big surprise, of course, because you would never buy CSL for the dividends. The other, obviously, comment to make is that the share price appreciation of CSL, which you can see on the chart, has been nothing less than spectacular. So while you would get more dividends out of CSL, you also get a spectacular share price performance on top. The opposite has been that you would have bought Telstra, and many have, is that not only have you missed out because you thought you were getting more dividends, but you didn't. Also, the share price today is, even though it is making a comeback, but it is nowhere near to where it was even 5 years ago, let alone at the time of listing. The secret in both narratives, so to speak, is growth and dividends. And we're going to talk about that a little bit more during today's presentation, but just keep that in mind. And this just shows you that if investing is over a period of time and not on a day-to-day basis, that it's very important that you don't make your strategies centered around the face value of things. Let's take it a little bit of a step back. According to some analysts, we are facing a super cycle, not necessarily in commodity prices, although some analysts are making that forecast as well, but we are facing now a super cycle in dividends for Australian investors the next 2 or 3 years. That, of course, is a fantastic prospect. But we have to realize there was something that became before that prospect, and that is we first went through a very, very, very tough period. And here at FN Arena, we've become known in certain circles in Australia, but we've been doing this for quite a while. We spend a lot of time in reporting on and amalgamating and collating the data and the statistics from corporate Australia during reporting seasons. And I've rounded up here the reporting seasons of August 2019 and of the one that came after that, February 2020. Now, in August 2019, that was one of the, if not the worst reporting season in Australia post the GFC. And what I want to draw your attention to is here that we have the total percentage of companies that actually beat expectations here was below the percentage of companies that actually failed expectations. And I don't think we had seen that before. And it's definitely not something that happens on a regular basis. At the time, we here at F&R and me personally, we started warning investors that they should prepare for dividend cuts, and they came fast and brutal. It started with the banks, of course, and it went on to a lot of cyclicals and energy companies who, in the second half of 2019, removed or reduced their payout to investors. In other words, in 2019, the corporate Australia was not in a good shape, and investors would have felt that through the share market. It's important to know that there was no sign of any pandemic at that time. That was strictly taken the state of the economy and the dynamics that, in particular, the old economy companies, a lot of the large caps were beset by it at that time. Of course, next things got a little bit better in February, but that was the early stage of the pandemic. And then we moved quickly forward to August last year, and the damage, of course, was there. Having said so, there was a lot of support for companies coming from central banks and from governments, and that sort of prevented that everything fell into a quagmire. But nevertheless, if you look at the numbers at that time, and I'm not so much focused on the beats and misses there, because it's very difficult for investors to accurately assess what happens in very deep recessions, and in particular one that's related to the health scare. But if you look at the numbers here, the average earnings per share in August last year was down by 20%. That's the average. And to make it even worse for a lot of investors, the dividends, the fall in dividends was almost double that. It was 36% on average. So it's much worse in a lot of individual cases. You see here on the right-hand side, more than half of Australian companies were unable to report any form of growth. And at the bottom here, you do have pockets in the market, from technology to healthcare, to obviously the supermarket owners and a few other sectors. They kept on performing, and they would have also kept the share prices up and dividends coming for shareholders. But this year, of course, things are changing, and all of a sudden we go within the space of less than 2 years from potentially the worst reporting season post GFC to the best reporting season in at least 2 decades. I've taken this from a JP Morgan report after the reporting season, so I don't have to say it, but you can see from their glowing assessments with the growth at the bottom. We haven't seen any reporting season like it in Australia, and if we had, it would have been a very long time ago. Of course, we do come from a low base. Last year was terrible. 2019, we forget that, but 2019 was horrible as well. And what is a very good sign, what we are seeing, one of the reasons why some analysts are using the term super cycle for Australian investors in the context of dividends, is that the return of dividends is stronger than the return in profits. And that is to a very large extent, of course, a compensation for the fact that last year it was the opposite, the other way around. Now, as you can see from this chart here, and this compares some foreign markets with components of the Australian share market, is that the large cap stocks have seen the largest increase in dividend return forecasts. And that obviously illustrates the fact that the banks are back increasing their dividends. The insurance companies are doing the same thing. We have some property developers, etc. And in many cases, they are concentrated amongst the top end of the local market. So it's more of a large cap event than it is from a smaller to mid cap event. But nevertheless, dividends are making a strong comeback in Australia, and I can only assume that will be to the pleasure of many investors. One of the elements that is not often emphasized, and I'm always happy that I'm able to find the few research pockets that do spend time on it, is historically there is a strong correlation between rising dividends and the share market performance in a positive manner, it shows itself on the individual level, but it also shows itself on a general level of the market overall. If a certain market has dividends growing, then usually the share market responds very well to that and is carried by that, more so than a relationship with profits. So the fact that we're now seeing a strong comeback in dividends, should all else being equal, should be a positive for the share market as well. Now, on the background, of course, and one thing that is making a major influence this year, and in particular in the volatility sense and in the reversal of share market dynamics, is the bond market. And we've been talking about the bond market a lot at FN Arena. I regularly write for FN Arena subscribers, and I can almost not remember that I wasn't mentioning the bond market in 2021 so far. When I returned from the end of year break in early January, I predicted that 2021 would be the year of the bond market in general terms. And I think 3 months into it, I think that's exactly what we've seen so far. The importance of the bond market is usually not something that is emphasized a lot prior to this year. It's because usually it doesn't matter that much, but now it does, and that's because bond yields are so low. You can see the trend there since the 1980s. My view, if it counts for anything in this prospect, is that we are trying to trend back to levels we had pre-COVID, which means we have to go back to pre-February 2020. And bond yields on the 10-year, roughly taken, were about 2.5%. Bond yields are not there at the moment. It probably won't go in a straight line, but I do think that's ultimately where bond yields want to settle again, which basically means there's more of the same in store, not necessarily at the same speed. Let's hope not. In the meantime, apart from the fact that this benefits financials over technology stock and growth and quality stocks, it also has a major impact on yield stocks in the share market. And that's why it's worth paying attention to, even if you're not investing in technology stocks, in growth stocks, and in quality stocks. You probably have to adjust your strategy in the share market when it comes to income for investing, for income, investing for income, and yield as well. So it's worth making that point. I don't think we should be talking about it too much, because I can always relate back to it a little bit later down the presentation if need be. So we've done the two narratives. Hopefully they'll stick for longer. We have done a little bit of a broader picture of what happened pre-March 2021. Now let's start with the strategies. And this is the reason, this chart is the reason why I say investing and dividend investing are basically joined at the hip. There's not really a difference between the two. And why is that? Well, if I just take a step aside and I forget about the fact that I want to have income from the share market, what I want a return for my money, including income. Then historically, and this is backed up not just by my research, but there's lots of research out there that will back up this if you read the right research, is that the best returns in the share market over time are being achieved by combining income with growth. Now you can turn it around. You can turn around growth with income, but it doesn't matter because it's like a mathematical formula. It happens and it matters in both cases. So the combination of income with growth gives you the superior investment return in the share market over time. The second best strategy is if you simply focus on growth. So you forget about the income and you're not interested in dividends and you only focus on share price appreciation. The worst performing strategy is if you only focus on income. And this exactly summarizes why I think a lot of investors make the mistake and go wrong. They focus too much on the income side of things. They underestimate the growth side of things. And instead of having the superior investment return, they go for the worst one. And that's not the one you want to have in your portfolio. You want the other one, I'm assuming. Now, 5 years ago, I published a book, was already mentioned at the beginning. And in that book, I made this point. And I made the point that you can use, you as well as I, can use the dividend yields in the share market to assess how much risk is involved, all else being equal. I mean, it is in general terms. And what do I mean by that? And that's what I illustrated in this little overview here. I've always said to investors, the sweet spot when it comes to investing for in the share market is with a dividend yield between 4 and 5%, usually between 4 and 4.5. And you can see on this little chart that is close to reality. It didn't apply anymore pre-COVID because share prices had appreciated quite a lot. It was probably closer to 4 than to 4.5. But now that we've had the recession and we're now in the recovery phase again, we again have share prices at lower levels, in particular in terms of the available yield. So this applies once more. What the share market actually does is it prices stocks at a perceived risk. And when the yield for dividend paying companies is up to 4%, you can assume that the share market is very confident that the risk is very low and growth is there. And that's why those share prices are priced at that level. Remember the CSL I mentioned earlier in comparison to Telstra. See, Telstra would have been much higher up the scales, in particular in the past. At the moment, not so much. Basically indicating that in the past, at times, the yield was, the risk was a lot higher. I mean, I remember Telstra at some point in the past was trading at an implied yield of 11% plus franking. And of course, as it turns out, since then, the dividend has been halved in multiple steps over the subsequent years. Needless to say that, of course, you can take the risk of buying a 7% yielding stock or even higher, but you just have to be aware that is not a free for all, and you're actually taking on a much higher risky strategy. And then, of course, when the bad times happen, as happened in the second half of 2019 and in 2020, then those are the most likely ones that cut their dividends, and you'll be worse off. Because we all know it's not just about cutting the dividends. What happens to the share price counts as well. And usually, when companies have to cut their dividends, the share price gets a little bit of a battering as well. And the opposite happens when companies can continue to increase their dividends. Those share prices tend to hold up really well. Now, just an overview. One of the things we do there for Arena is we have a lot of statistics and data. So once you know where to find them on the website, you can ask things like, which are the highest yielding stocks at this particular point in time. This is the top 10. Quite remarkable. I think everyone will agree with me. This is usually the territory of infrastructure stocks and of REITs and the occasional retailer. At the moment, half of it is commodities. It's iron ore, it's coal, and there's the occasional utility in there with AGL Energy. There is Adares in there, which is online retail, and obviously at the moment priced for discontinuation of last year's momentum. And there's exactly 2 REITs in there: Centuria Office REIT and Waypoint REIT. And the reason why they're in there is because obviously the share prices have been trending down because of rising bond yields. It doesn't mean that any of those stocks shouldn't be bought. It just means that they all have specific risks. And it may be that those yields, of course, won't stay around for too long. Or in some cases, I've noticed, for example, the Dalrymple Bay Infrastructure company that only listed less than 6 months ago is buying in their own shares. So obviously they believe the market is pricing them in the wrong way. This is how most investors treat dividend investing. I've now taken Telstra as the example. Telstra is making a comeback after having had I must say, quite a how do we describe this? A not so good track record for investors over the years. Full disclosure, I'm currently a shareholder in Telstra, but I do not intend to stay on board forever and ever. My view was that with the changing in dynamics in the share market, that companies like Telstra, who are going to cut up themselves in smaller pieces and then sell off parts of the farm, that would unleash value for shareholders and lead to very much higher share prices. I'm not necessarily there for the 16 cents in dividends that the board is promising me, but for the moment, the board is promising investors 16 cents. And this is how I believe, on my observation, on my experience, how investors treat dividend investing in the share market. So when I was making these slides, the share price was at $3.33, and I thought, let's grab that one, because that's very remarkable. And at that point in time, the yield on offer at 16 cents is 4.8%, which is above market average. Market average is now closer to 4, in recovery and rising, but at 4.8, Telstra is still offering investors a higher yield than the market average. Now, Harry Hindsight, and I'm sure he every once in a while visits many of us, Harry Hindsight would tell us, but late last year, we could have bought Telstra at $2.70, which is, man, that's $0.50 less than today. That would have given us a yield of 5.9%, almost 6. And like, if only we bought it at that price. Okay? Now, Telstra share price is now a little bit moving upwards, and it's approaching $3.50 now. I'm taking a rough view here. Assuming it goes to 350, the yield then is getting closer to 4.5%. So you see that the yield is declining as the share price goes up. This very morning, Morgan Stanley upgraded Telstra and had a price target of $4 on it. It just happens to be that I put that on the slide as well. It just happens to be that at $4, the prospective yield of Telstra would be 4%, which would be at that point in time below the market average. So you can get better yields elsewhere all of a sudden because the share price has gone up. Now, the problem with investing like this is that the level at which you enter the share price becomes incredibly important and determines your return, because it's just the 16 cents is not going to change. Now, let's now assume that we can do better. And the better way is that we make it less dependent on what happens to the share price itself, but more to what happens with the underlying company. And I've taken a imaginary example at 4%, which is definitely available in today's share market. And let's assume this company grows at 5% per year. It's dividend, not necessarily the profits, but it's dividend. And we assume then the profits will grow by more. Now, of course, it won't be 5% exact every year, but let's say on average, that's what it does. What it means, in short, is that after 5 years, you will have 5.1%. So your 4% grows into 5, more than 5% from your original purchase price. And as you would have known by now, when this happens, the odds are very much in favor that you will also have a higher share price by then. Growing dividends, very strong correlation with higher share price. So you also avoid the dilemma with sitting on, for example, a Telstra, that irrespectively of when you buy the share price, it might be lower in 5 years' time. Now, that was the theoretical base. I also thought I'm going to add a real life example. And when I was going through some parts of the website recently, I came across Accent Group, which is broadly regarded one of the better retailers we have in Australia. It doesn't mean the share price goes up all the time, because retail can be volatile during cycles. But Accent Group has been a strong performer over time, and it has done one thing particularly very well. It has increased its dividends over the past 3 years by a lot. And what I'm showing you here is one of the applications we have been running on the Alpha Arena website for I don't know how long, but for a very long time. And we call it the dividend yield calculator. And what it basically does is the system tells you what a certain company has done in terms of dividend growth over the past 3 years. And in this case, Accent Group, it has grown by more than 15.5% per annum. Now that's meaty growth. That's pretty big. Now, if we assume, and this is what the system shows you then, if we assume that, okay, let's assume they can continue doing that for the next 5 years, then you see that a yield which is slightly under 4% grows and actually doubles. So you double your yield on your original purchase price in 5 years if you have the opportunity of buying a company that has a lot of growth under their belt and can translate that growth into increasing the dividend to shareholders, the payout. Now, again, everything I told you earlier about the CSL versus Telstra and all the other examples, it actually comes back to this real life example of the Accent Group. If they don't do that 15.5%, you will probably still have a big increase. And the difference with a stable 16 cents payout, which we discussed earlier, should also be very, very obvious from this example. I usually say this in all my presentations, and I usually say to investors, like, you know that the cure in the share market, be it a recession, be it a slowdown, be it a strong currency, be it government failing government policies, be it rising bond yields, the cure for all the ailments in the share market is always growth. I mean, growth will beat and keep everything at bay. What I usually don't emphasize is that this also in particular applies to those investors who have strategies around income and yield in the share market. It counts as much as for other investors as it does for that particular type of investors, which again brings me to the point that there's not really that much of a difference between investing for income and investing without the income. It's just that it sometimes is being painted as a complete different class, but it actually isn't if you watch the elements that you should be keeping an eye on. Now, last year, slight step back to last year. Last year, I said to investors, well, I am able to draw up a list of about 10 of the best dividend payers on the ASX, for which the chances are very, very, very low that they will have to reduce their dividends at some point. And if they do, it will be in a minor fashion only. And these were those 10 stocks I presented to investors. And they have, of course, they haven't cut their dividends. Come pandemic, gone pandemic, come lockdowns, gone lockdowns, through the cycle and all of it. Two companies stand out in a little bit of a negative sense, in that APA Group and Macquarie have or are or will be reducing slightly their annual payout to investors, but it should be a one-off only. The added comment, however, I need to make is that because we are now in a different environment of rising bond yields, it means that those on this list who are typical REITs, they will underperform, and they may not be your best investments for this year in 2021. In that the price of securities will be depressed, will trend lower for as long as bond yields keep on going up, and that's unfortunately how this type of the animal works. So on this list, the likes of Macquarie, MCOR, Coles, Woolworths, they are almost destined to outperform the typical REITs on this list, for the simple reason that they have more growth under the belt, and they do not respond in the same fashion to rising bond yields. Special mentioning at the bottom, of course, the iron ore producers are now, as we've also seen earlier, are now amongst the better yield payers on the ASX, and that's quite remarkable, and shows you also how extraordinary the times are, in particular for iron ore miners. There is a different strategy, of course, which we can apply, and which maybe falls more in line with the times that we are living through. I mean, we've had a very deep but very brief recession last year with big dividend cuts, and we're now experiencing a very well. We yet have to see how strong it will be, but it has come very quickly. The economic recovery this year, which then also now is going to translate into the recovery in dividends. And just as an extra sidestep, just saw this morning that UBS has issued a report as well, in that investors are underestimating the return of dividends. So it will be stronger than is currently forecast, and will be stronger than currently is priced in, which is another positive, in particular for those who are looking for that type of stock. Now, the dividends returning, the sectors that immediately come to mind are the banks, the insurers, and the other financials, the energy sector, and infrastructure sector. Now, some of these will still be very much linked to economies reopening and to lockdowns not recurring, which is an extra layer of risk, of course. But I have lined up some of the logical candidates to play this theme, apart from the banks, of course, which have been scooped up by many already. You see there's some insurance in there, although they obviously have the risk of weather events. You see some fund managers in there, and they obviously have the risk that if something happens in the share market. And you also see, for example, a Smart Group and a Stockland. And full disclosure, I am a shareholder in Super Retail, and I think Super Retail is one of those companies through which this move in return of dividends can be played in a very, very beneficial sense. There's a lot of research done on the importance of dividends. Unfortunately, and this is something I never understand, a lot of that research is always done in offshore markets, and while New Zealand and Australia are amongst the dividend capitals in the world. But that aside, I grabbed this from a survey or analysis, I should say, done in the United States. This one in particular is specialized in dividends and income, and as you can clearly see on this chart, is that the longer you are in the share market, the further out your horizon stretches out, the more important the income from dividends becomes in your total return strategy. And there is obviously the obvious connection, and that is that share prices do not always go up. But if you have the right companies, then you will always continue receiving the dividends, and they should grow over time. So it instinctively makes sense that the longer your horizon, the more important the importance of steady, reliable dividends is. Now, this particular slide, which is from a similar type of research done in the United States, brings me back to the very core of some of the items that we've discussed throughout this presentation earlier. In that on the left-hand side, you see that the highest return, which in this case is 9.6% on average per annum, was achieved by investors who held companies that either introduced dividends, like they weren't paying it previously, but they started paying it, or they were paying dividends, but they continued growing their dividends. And as you can see from this overview, not only is that a portfolio that handsomely outperforms the overall index, it's also the superior strategy, again, as I said earlier in the presentation. And again, emphasizing the danger that comes with typical focusing too much on the income part, is that the absolute worst performance, which is actually negative on average per annum in this research, and this runs between 1972 and 2010, by the way. So the negative return on balance was achieved by those companies who had to cut their dividends or had to eliminate, basically stopped paying out dividends. And that's of course because you don't only lose your income, you also get clobbered on the share price. And the combination of those two can be quite devastating. So there is your difference between the superior strategy and between the strategy you basically are better to avoid. Easier said than done, of course. We are almost at the end of today's presentation already. Time goes fast, I know. In 2011, for those who want to combine more insights about investing in dividends with a little bit of entertainment, in 2010, I was invited by the ASX to give a presentation here in Sydney, and that video is still available on YouTube. I mentioned it here. You can access it through the slides, or you can find it on YouTube. I think it's still funny. It still carries a lot of insights from that time, which you will find are not that dissimilar from what I've been telling you today. And just before, that's at the time why it made such an impact, is because I actually turned up in the form of an alien. Just before we go to Q&A, which we always leave some room for that one as well, is that over the past 5 years, I've particularly been investing in quality growth models in the Australian share market. That includes sustainable dividend payers, which I always regard as part of a well-diversified sustainable portfolio. Unfortunately, or maybe not unfortunately, we have to adapt every once in a while as investors. This year, I've made a decision that, I think with one exception, I no longer own REITs in that part of the portfolio which is aimed at getting the income on a sustainable manner. I'm now owning stocks, for example, like a Telstra and a Super Retail and an Amcor, companies that pay me out a good yield on the price as well, but will have the capacity to add more shareholder value, either through growth in the case of an Amcor or a Super Retail, or either through selling off the farm, and that's the case of Telstra. For those who are interested in the type of research I do, and you would have had a little bit of a taste through today's presentation, I on a regular basis update a secret report, which is only available for those who know the address. And the address is quite simple, as you can see here. You do the fnma.com/secret, and there is a report for you to read, which has typical stories like I mentioned at the beginning of this presentation. That was it, actually, and I hope, of course, that you liked it as much as I did, and that you get your benefits from today's presentation. And I will be available now for Q&A, which means I stop the screen sharing if it allows me to. Oh, here it is. Yes, I'm back.
All right. Lovely. Thank you, Rudy. Just for everyone online there, Molly Benjamin introduced us at the start of this webinar. My name's Peter Wells. I'm one of the directors at Australian Investors Association. Just before I get to questions, I just want to remind people who are online, we do have a one-day summit coming shortly on 22 April. Investing 2021, Protect, Panic or Profit in the post-pandemic world. And Norman Swan and other speakers will take us through that. So that'll be great fun, very interesting. So on our website, if you're interested, either online or in person, please have a look there. Now, firstly, thank you very much, Rudy. Your talks and your newsletters are always very informative, and they certainly make us think, which is, it's always good to deal with the data and what's actually happening. I've got a range of questions here, and people that have sent them in, I hope you'll forgive me. I might be able to combine one or two of them, and we'll just run through them in the time available. One of the first ones we've got, Rudy, is do you see inflation re-emerging in the near future?
Yes, I don't think that's the real question here. I think the real question is, if inflation does emerge, will it stick around or not? And that is the multi-million-dollar question at the moment. So at the moment, we seem to have a perfect storm of ships getting stuck in the Suez Canal, to geopolitical lines of supply being disrupted, to companies not having anticipated correctly the strong jump in demand for their products. For example, there's a global shortage in computer chips. The combination of all of the above will lead, all else being equal, to a rise in inflation, which we probably will see by mid this year. The question is that a temporary element, or is that something going to stick around? I personally think it's going to be temporary, but my view is as much worth as anyone else in the market at this point in time. As I said earlier, I believe that bond yields are simply reverting back to where they were pre-COVID, which is still higher than where they are today. But for a lot of reasons, that move in bond yields has created a narrative in the share market that inflation is coming. And that's not necessarily the case. At the moment, that's the mindset. But we've seen in the past years that a mindset can change quite quickly, and that what the market believes is a given at a particular point in time might as well be wrong 6 or 7, 8, 9 months down the track. I still remember the second half of 2016. It was similar. Bond yields up, inflation coming back, and within 5 months we all forgot about it and we moved on and we never looked back. This time I think it will stick around longer, not because inflation will stick around, but it is coming, as I just explained. And also I think bond yields probably have more to move upwards, and that will keep the narrative alive of inflation's coming.
All right, thanks, Rudy. The next question you may want to issue in terms of particular shares or categories of shares, but the question is, what shares provide the best mix of income and capital gain for a self-managed super fund?
Yes, well, I think that was like that I talked about for 45 minutes, I think. I mean, at the moment, I mean, you have to weigh up the fact that you can buy companies at 4% yield, maybe a little bit higher, a little bit lower, and if they are in a position to grow their dividend payouts to you, then it doesn't really matter in what sector they are. But if you have an horizon for let's say 2 or 3 years, then I'm going to be very boring. But it would appear that your Australian banks are excellently positioned to grow their dividends over the next 2 or 3 years, and 3 of the 4 banks, less so ANZ, maybe with a big question mark, Westpac, but definitely National Australia Bank and CBA will pay out extras, like an extra dividends on top of the dividends, and they might even add more extras in buying in their own stock and stuff like that. I'm a big fan of companies like an Amcor, for example. What people also forget is that at times when share prices for the likes of car sales fall far enough, that they all of a sudden start offering 3.5% yield, and those companies, as you know, they have a moat and they do grow. So the trick here is not necessarily to fall for the 6% company or the 5.5%, but sometimes you get more out of a 3.5% yielder, and car sales, for example, would be an excellent example for that.
All right, thank you, Rudy. Just another question here that you did touch on, but you may wish to expand. How long do you expect the resources dividend boom to run for?
Yes, yes, I know. Was Jesus Christ born in the year zero or the year one? It's a that's my observation is that very few people believe that iron ore could stay as buoyant as it is now, and there are very good reasons to assume that we will not live through another decade of very high iron ore prices. Having said so, iron ore price today is still very high, and it's probably going to remain high in the second half of this year as well. The problem with resources companies is that things can change quite quickly, and it's now really up to China, and things are changing in China, so things could change anytime or quite quickly, which is why most investors treat commodities in a different way. In particular, when it comes to dividend investing, in a different way than they would do with financials or with industrials. And history shows that that is the correct way of treatment. I mean, one of the things we should always keep in mind is that sometimes when a sector is out of favor, it offers high yields. And a perfect example in the share market would be the coal companies, including companies like Horizon, for example. And we also see, for example, that there's a high yield to be had from AGL Energy. But see, that's a company in trouble. And I think we should be careful that we don't fall into those yield traps. And I personally, I very much would prefer to own a company like Emco or Super Retail instead of Horizon or New Hope Corp.
Yes. All right. A question I've got here: where in the market do you see value at present, and where do you fear that it's most overheated?
Let me touch upon the second question first. There are a lot of people who believe that equities are overvalued, and you, on a regular basis, hear the terms bubble happening. I mean, it's always a big question mark when you live through the moment, and in hindsight, it's always very obvious. I don't think that share markets are exuberantly valued. I do believe that there are pockets in the market, predominantly in the United States, where all the excesses of bull markets are happening. The problem is then to assess how much that translates into Australian equities and how much that impacts. That is very, very difficult to do. Equities are higher priced than they have been historically, and I think there are for multiple reasons that is justified. Coming back to where there is value truly is in the eye of the beholder. What is happening at the moment is that the laggards from last year and the COVID losers from last year are back in favor this year, and they're all being bid up in share prices. And the quality and the growth stocks from last year and the winners from COVID last year are a little bit out of favor this year. Personally, because I have a view that goes beyond the adjustment in the bond market, I think longer term, the obvious opportunities are in the stocks that are out of favor today. You have very high quality companies in Australia, ranging from Cochlear to ResMed to CSL, and even in the tech space, Altium, Xero, etc. Those companies at the moment can't put a dent in the bag of butter, but they will become highly regarded again at some point. Having said so, I also believe that point is not now, and we may well have to wait until 2022 arrives. But maybe life will surprise me in that regard. I am a shareholder in some, if not many, of those companies, and I do not intend to wave goodbye to them, even if the share price falls tomorrow, if that makes sense. The other strategy, of course, is that you can bank on the fact that dividends will return, operations will resume from those companies that have been hit hard by COVID and by lockdowns. That's a complete different strategy, and you can be disappointed in the fact that you may have to wait for longer, because we may all be too optimistic in how quickly life will resume to pre-COVID days. And there are obvious examples for that, ranging from Qantas to Transurban and Sydney Airport and Auckland Airport, etc. But that is personally not something I would recommend unless you have the stomach and the patience for it.
Thank you, Rudy. The final question, just from a person online, Mr. and Ms. Adams, is: do you think we're entering a resource super cycle? And more importantly, how long will the likes of Fortescue and BHP be able to pay their high dividends, or perhaps will they have to cut them? And when might that be?
Okay, I'm gonna do a wide stab in the second part of that question. I think within the next 3 years, those dividends will come down significantly. Picking the exact point when that is incredibly difficult. But I'm not a betting man, but I would be willing to bet that in 3 years from now, those dividends will be a lot lower. When it comes to the first part of that question, I think the denomination of a super cycle is just like a bubble. It's very difficult to. Not everyone is necessarily talking about the same thing when they use those words, but what I think is more important is that what we have experienced in the share market over the past few years is an extreme polarization in between the different parts of the share market. And if you were on the wrong end of the stick, you will at times really getting frustrated and nothing was much happening there, even though you obviously thought that you were doing the right thing. I think we are only a step away from that happening in the resources sector. I think people will be making a mistake if they only buy resources for the economic recovery and for the China policies. What is increasingly going to happen is that we are decarbonizing economies. We are developing sustainable sources of energy, electric vehicles, new types of batteries, and all of that. That is going to split the commodity space in two, just like it now has done in the share market. And there will be winners and losers, and the difference between the two will be significant. Yes. And I think the fact that you see sort of the demise of coal happening in the share market, and there will be spurts and growth and rallies along the way, but I do think coal is on the way out. And I think the next shoe to drop is, at the moment, the most popular sector in the share market is the energy sector, oil and gas. And I think in 10 years' time, we're going to all look back and we're going to go, my goodness, iron ore was so expensively priced at that time. And in 10 years' time, it will not be the case. That's almost a given.
Yes. All right. Well, I'm conscious of the time, and I think the clock's got us. I'd like to keep going, but I know people will have other things to do. So that was very informative, Rudy. Thank you very much on behalf of the Australian Investors Association. I'd remind people that are online, you're very welcome to check our website for the various resources, and we'll post the slides from Rudy's talk shortly that you can avail yourself of if you want to pick up some of the detail of what he covered earlier. So for today, thank you, Molly, earlier for organising the talk today. Thank you very much, Rudy, for your time, and we look forward to the next webinar in a couple of weeks' time. And don't forget our summit on 22 April. All right. Thank you very much, Rudy, and thank you everyone for logging in today. And I hope you enjoyed today's webinar. All right. Thank you.
My pleasure, guys.